In this week's video, we'll take a step back and review the key battles being fought by the Bulls and the Bears. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is the S&P 500 from a weekly perspective. This is what a bearish situation looks like from a probabilistic perspective. This is what a bullish situation looks like here. You can see we've got somewhat of a mixed bag with our moving averages being close together. However, blue is trying to cross above red, which looks more like this than this here. Also, what once was resistance may now act as support. So the market is telling us that somewhere around 2000 to 1975-ish, this remains an important level. We also had a downward sloping trend line here on the weekly chart, and we were able to break that. As long as this area here holds, we'll try to be patient, and you want to trade less in this area here, and your confidence will increase from a bullish perspective the further we can move in this direction. If we stretch it out and look at some longer time frames on a weekly chart, notice here that the slowest moving average, the dotted moving average, is on the bottom in the present day. It's just the opposite for a bearish profile. For a bearish profile, your slowest moving average is on top and your fastest moving average is on the bottom. So the present day profile, dotted and dotted, looks more like a bullish period than it does a bearish period. The other side of the coin is, notice how close the moving averages are together here. See, we can see white space here. This is a stronger trend here. This is a weakening trend, and our slopes have gone from down to up to down to back up. This tight look here is telling us that a relatively big move could be coming. Example, see how tight the moving averages are here? And then really, really good things happen. Notice how tight the moving averages are here, and then really, really bad things happen. This is the daily chart of the S&P 500 index that we've been using for several weeks now to monitor this trading range. Early in the week, we got somewhat of an intraday scare moving below the trend channel. That's why we often talk about the importance of closing prices. This shows you the close here, close near the high of the session on Monday, and this is the price swing or activity during the day. Typically, not always, you're better off waiting to see the closing price, which is a better indication of the battle between the Bulls and the Bears. In this instance, patience paid off and the market rallied. However, it did break below this line, telling us to keep an open mind about another trip in this direction. We had basically the same thing occur here. We popped above 2064 on Friday, but we're not able to close above it. There's really not much new to report here. 2064 is still a relevant level. 2072, which was Friday's high, now becomes relevant. And all of these levels that we've been watching, including the 1976 Fibonacci retracement, are still in play, and they're still important. We're still in the do less rather than more. What do we mean by that? We don't want to be making allocation changes here if we can avoid it. Why? Because the market remains indecisive. We don't want to move heavily to bonds down here because we don't know if that's where the market's going to go. Conversely, we don't want to make 100% bet in equities or increase our equity stake until we see that we can at least close above 2064. We did get a relatively weak close on Friday, and we didn't close above 2064. However, the S&P 500 still had a good week. It was up over 3%, as you can see where my cursor is for the full week. And taking into context that we were down double digits intraday on Monday morning, it's a pretty impressive rally. We also, from a momentum perspective, have some improvement. Here, when Williams percent R crosses the center line, the probability of good things happening on the weekly chart increases. Cross the center line, the probability of good things happening on the weekly chart improve. We did recapture the center line. It's better than where we were a week ago. And this does tell us that the odds of good things happening are higher today than they were a week ago. We also have price that recaptured the 22-week moving average, which can be used as somewhat of a generic monitor for the strength of weekly trends. Looking at the Nasdaq's 22-week in blue, you can see when price drops below any moving average, including the 22-week, and the slope rolls over, the probability of bad things happening increases. Compare this period here to the present day. The trend on a weekly basis looks a little vulnerable with price, but the slope of this here is much, much better than the slope here, and price remains above. Everything that we said about momentum or Williams percent R on the previous chart of the S&P 500 applies to the Nasdaq Composite as well. The weekly chart of the VIX also cooperated with the bullish case from a probabilistic perspective. The VIX dropped over 16% this week. Also, we did not close in this area here. Here's the weekly close. So the high came up and challenged this area intra-week is what this shows you. And this little cross here shows that we closed well off the highs for the week, which also can be translated into fear closed well off the highs for the week. The bad news is these moving averages are moving up. So much like the stock market, nothing particularly clear here, but we also didn't get something that clearly backed the bearish case heading into next week. We've covered this before, so we'll move quickly, but we did see something interesting on this breadth chart on Friday. NYSE new highs, stocks, the number of stocks making new highs, minus the number of stocks making new lows. As we've mentioned in the past, this is what weak market breadth looks like. You have a divergence here as the stock market peaks in October of 2007, telling us that fewer and fewer stocks were able to make new highs, even though the S&P 500 was able to do so. This is a yellow flag. I wouldn't call it a red flag. We look much, much better today. Also note, when we replace this chart at 1:50 p.m. today, this chart was up 4.53%. At the close, it had actually improved in the last 2 hours in 10 minutes of trading, which is probably not what you would expect late in the day on Friday. But behind the scenes, breadth actually improved using this indicator between 1:50 p.m. and the close down here. We closed up 4.66%. I would term this anecdotal evidence, but it continues to tell us to keep an open mind about the possibility of a bullish resolution. As always, the markets will guide us if we're willing to listen with a flexible and open mind. A big part of what the CCM market model does, it provides reference points to help us make rational decisions. This is a monthly chart of gold. I've purposely removed price, and we're just focusing on two moving averages. This is the faster moving average in blue and the slower moving average in red. This is a bullish profile with blue above red, and the slopes are up as gold was a good place to be. This chart in isolation has helped us stay out of gold since really late 2011. You get a bearish moving average crossover, blue below red, and the slopes of these are down. This looks nothing like this bullish period here. We've also failed to get a bullish moving average crossover yet. This is improving, but it's still telling us to be patient. Momentum is in the same boat. This is not a very confident look with a monthly Williams percent R. What is a confident look? When you can clearly break the center line And better yet, look, we move here into overbought territory, and look how long the gains continue after the observable evidence changes. What do the tight moving averages tell us? We can see it a little bit more clearly here using simple and common moving averages, the 50, the 125, and the 200 here in red on the NYSE Composite Daily as of the close on Friday, February 6th. What this is telling us is that the intermediate term trend with the 50 and the longer term trend with the 200 are converging, and it speaks to our indecisiveness. And this flattish look makes sense when the Fed is getting ready to change policy. So look how close we are in here, telling us to pay attention next week. Price above is good. Price below increases the bearish odds. Here you can see that we stopped at a logical level here. Either one of two things probably happen next week. We'll probably break out, and these tight moving averages tell us that it could be a relatively big move, or these trend lines could continue to bound price and we could move below. And then when we get back down into this area here, we really have to be willing to cut risk if support doesn't hold. It held last week, and we'll make sure that we're patient, but if it breaks, we need to make some changes. This is the NYSE Composite Weekly as of 2 o'clock on Friday. The purpose of showing it is just to say not much has changed. You can see we've been going up, we've been going down, we've been getting whipsawed around on these shorter term time horizons. If we consider this to be what's known as a symmetrical triangle, which is a continuation pattern, for it to be bullish and carry good probability, we need to break to the upside fairly soon. If you keep moving up and down and basically move to the apex of the triangle, you've basically lost your triangle from a probabilistic perspective. If you break to the upside near the apex, it's not as good. You want to do it roughly 2/3 of the way down, and we're probably already past that, so time is short for this to be a valid symmetrical triangle. It is a continuation pattern, and the pattern prior to this was bullish. So it does, again, tell us to keep an open mind. We'd love to see, if you're a bull, price move in this area. If you're a bear, you'd like to close down here next week. A few quick anecdotal examples. Our trends and our moving averages converge. In this case, we get a break and a big move to the upside. Start to cluster and converge here. We get a sharp break to the downside. Somewhat of a sideways look here, and somewhat of a tepid move to the upside, but the trend is up in this case. The symmetrical triangle in this video showed that the NYSE Composite has not made a new high since June of last year. That's the bad news. The good news is resistance on the line, resistance, resistance. What once was resistance may now act as support, acted as support again. And you can see the market has held again and again in this general area here. Obviously would like to see a new high. This could be your left shoulder, this could be your head, and this is a messy looking right shoulder. The concepts, however, still apply. This is a spike in fear, a bigger spike in fear, and then a lower spike in fear. This spike here is lower than this spike here, which would be your head. It's a daily chart of TLT, or long-term treasuries. Purpose of the exercise: it's a little too early to get overly concerned about this move. Why? Notice the slope of these trend lines. They're up. Pullbacks occur, pullbacks occur, pullbacks occur within the context of an uptrend. We also have what once was resistance. This is an intraday move that was rejected here, rejected in the same general area here, support here. So these two dotted horizontal lines intersect the trend lines, telling us that somewhere between 126 and 128 and change, we may get a test that's a little bit more meaningful than what we've seen this week. We'll keep an open mind. We've seen enough deterioration here mathematically to pay closer attention, but not enough yet that requires any action in what is a still relatively small stake in TLT relative to our equity-based ETFs. Looking at the monthly NYSE composite, there's no question with this price action here that the market thinks that this level here that bounded price in 2007 is still important. This too paints the picture of confusion and not much new yet, and we'll remain patient and we'll keep an open mind, and if we pay attention, the math, the model, the rules, and the charts will get us in the right place. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currency, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.